With just a few minutes on time, we can all be there for Prince people. Shape your future. Start here, 2026.
Have a couple slides. And then, oops. Thank you, Gracie.
Sure. No problem.
Let me start over. Okay, take 2. Forgot to hit record. So we're going to finish up chapter 2, system quality control. We'll get into that tonight. And then we will talk a little bit about ethics at the end of this chapter, very briefly. Again, Accounting 302 really digs into that, but it'll be worthwhile for us to hear what some of the sources of some of that information are at this point. And then we're going to really start hitting the road here, the detail of how an audit is carried out, starting with high-level planning, taking us all the way through discussion of materiality, and that's chapter 3. So I'm going to really try to stay on track to finish that tonight so that we can get caught up and not have this sort of straggling tail of slides from the previous class. But that's fine. If we have to go a little over, we can, in terms of having slides for next time. By now, you should have gotten into the McGraw-Hill Connect. You can see the homework and the quiz chapters in there. So do start taking a look at that. You don't want to wait until, the night before the midterm or anything to start to look at that. I have embedded a few questions from the homework and other material into these slides tonight to start to give you a sense for chapter 3, particularly start to really give you a sense of how we're going to test you for some of this material using multiple choice questions. And I'll actually use the poll function a little bit for that. So bear with me while I work on that. Before we get started, any questions, concerns that anyone would like me to address? No? Okay, good. So I'm going to go ahead and put this machine into tablet mode. So it might sing a song for us here as I do that. Okay, and let's go ahead and talk about quality control system. Now, the first thing we want to get in our mind is, well, what are we talking about? Quality control standards, system of quality control. So let's say you finish your degree here at Golden Gate. Let's say you decide to start your own firm. You're doing work, you're doing audits, etc. And you want to make sure that those audits are being done according to the standards. Remember, we talked last time, if you're auditing a public company, you have to follow PCAOB standards. If you're auditing a non-public company, you're going to follow the SASs by the AICPA Auditing Standards Board. And of course, the PCAOB points to the Auditing Standard Board standard. We talked quite a bit about that last time. Well, these are all standards that tell you how should you carry out an audit. But how will I structure my CPA firm so that I make sure that my audits follow those standards? Well, what you can see on the next slide is we have the elements of a system of quality control. This is, okay, this thing's gonna sing songs to me now for some reason. Okay, so bear with me. Hopefully it'll stop that in a minute. But basically what happens is we will set up this system of quality control, and this makes sure that our CPA firm, this is at a firm level, as we talk audit by audit, engagement by engagement. These standards is to how you would structure a system of quality control and make sure that your audits follow those standards. And so you can see these up here, and I'm not the best mnemonic guy, and I'm not a huge believer in mnemonics, but then again, something like this isn't something that you just think of off the top of your head. So if you don't mind, I'm going to go ahead and give you a mnemonic for this, okay? And by the way, the only thing that makes my mnemonics good is that they're so corny, okay? So they're so corny that you just remember them, okay? So the mnemonic that I'm going to use here is help Ma, okay? And we have what? We have human resources, right? That's the H in help Ma. We've got engagement performance. Okay, we've got our L here is leadership. Okay, we've got the P here, which is going to be, oh, forgive me, guys, I'm sorry. The E up here is ethical requirements, sorry. Okay, then we've got the P here, which is performance, engagement performance. Okay, then we have monitoring. Okay, and then we have finally acceptance and continuance of clients. And by the way, when we get into chapter 3, we'll talk more about the acceptance of clients in more detail, but these are the key quality control elements that a CPA firm should have to make sure that our audits follow the various standards that we talked about earlier here in chapter 2. Okay, so let's talk about leadership. Leadership is a tone at the top. So making sure that employees, the staff at the CPA firm understand what their individual responsibilities are to make sure that they maintain their independence, to make sure that they're keeping up their professional qualifications, etc. So this is something that comes from the top. You don't tell a brand new person, hey, you're in charge of making sure that we have quality audits. So it comes from the top. It's at a partner level. It's at a managing partner level. Relevant ethical requirements. Independence is a key ethical requirement that we'll talk about, but also due diligence, responsibility, these sorts of things we will talk about a little bit more, but ethical requirements. Acceptance and continuance of clients, very important. We're going to talk more about this in chapter 3, but I think we can all probably think from our study or reading about the Enron problem, and that the CPA firm, Arthur Andersen at that time, there used to be more than just the big four, there was Arthur Andersen as well, and they basically got dragged under by an unethical client. So you want to make sure that you accept a client that's going to have integrity, and if you continue with that client, they're going to have integrity. We'll talk more about how to look at some of those things when we get into chapter 3. Engagement performance. We're going to see that a key point here is going to be supervision. Okay, it's very important that we have the appropriate supervision on an engagement to make sure that it is being performed in accordance with, again, the standards that we talked about earlier. I skipped one, human resources. When we hire individuals that have the proper technical training, education. We make sure that they maintain that proper education, etc. And then monitoring, making sure that our engagements are actually following the various standards. Now, there's 2 ways that we can have monitoring. One is going to be an internal monitoring. And in public companies, it is a requirement that before we issue a report, a second partner, a reviewing partner, look at the work of the engagement partner to make sure that those audits follow standard. And that has to happen before the report is released. Now that's a requirement under PCAOB standards. And so you're saying, oh, so you don't have to do that if it's a public company. But what many firms will do as part of their system of quality control is for every engagement, whether public or not, have another partner who was not part of that audit team review the work before the report is actually issued. So that would be an internal monitoring. External monitoring, and the best way for having external monitoring is through peer review. Now, what peer review says is a firm of similar size will look at, and what they look at in a peer review, and sometimes you hear folks talk about, oh, peer review, they're going to look at my audit. Well, that's the last step in a peer review. What a peer review does is look to see if the CPA firm has these elements of the quality control system. And then the end piece of that is to see if the audits actually follow the SAS's, the PCAOB standards. So a peer review looks to see that you have the leadership, the ethical, the acceptance, the human resources, engagement, performance, and then the monitoring is there, that internal second partner review before a report is issued. And then they will actually pull a few audits to see if the audits then follow standard. And the other source of monitoring is if you're a public company, the Public Company Accounting Oversight Board will come in and look at some of your audits, and depending on how many audits you do, if you do more than 100, you would be looked at every year. If you do 100 or less, then you're looked at every 3 years by the Public Company Accounting Oversight Board. That's for public companies, obviously. Any question on any of that? Okay. Yeah. Did I hear a cry for help? No? Okay. Okay, good. So, guys, again, I understand, no one wakes up in the morning and says, oh yeah, what are the elements of the system of quality control? So I think that it's kind of silly, but that help mnemonic, okay?
I have a question.
Sure.
Could you discuss really quickly again engagement performance?
Yeah, engagement performance is just more the day-to-day running of the engagement to make sure that as we do our tasks on a day-to-day basis, that they're being performed, we're meeting the audit objectives, et cetera. So the big way to ensure appropriate engagement performance, quality engagement performance, is through supervision. Okay, in other words, I should be reviewing my staff's work papers fairly frequently, right? You don't have a staff do a task and then, 3 months later, you look at their work papers. There should be a timely review of work papers. There should be an appropriate documentation made on a work paper that the review was done, that the supervisory review was done, et cetera. These are the type of things that you would see under the engagement performance element. Okay. All right, good. Hopefully that answers the question. But again, as I was mentioning, PCAOB, if you do, and I always forget where the equal sign is supposed to be on this guy. So if I misspoke a minute ago, greater than 100 annual review. If it's 100 or less, then you get a review every 3 years by the PCAOB. So literally, sometimes people will call it peekaboo. I don't see how that pronounces peekaboo, but anyway, some people call it that, and that's basically, they say that because they're going to come in, and people always think, oh, they're going to look at my audits. Yeah, they do that, but they're really looking to see, do they have the elements that help me, and then they're going to pull a few audits to see if those audits have been carried out correctly. And they give us the hyperlink here if you wanted to kind of go and take a look at what the results of some of these PCAOB reviews were. Sometimes it's like watching, reading a car wreck or watching a car wreck or something, because they talk about different mistakes and stuff that firms have made. The other thing that you can read sometimes is sometimes it's helpful to look at mistakes that others have made before, right? And so you could get, in the state of California, they have the quarterly report that comes from the California State Board of Accountancy. And then in the back, they list disciplinary actions. And sometimes you read about some of the things that were done. I think I talked about this a little bit last time. And you're like, okay, this person's just a bad actor. They carried out an audit. And when the peer reviewers, and this comes, I'm talking about a non-public peer review that was done. Again, peer reviews, PCAOB does a review, but then peer reviews are, if I'm going to be doing certain audits, if I want to audit public companies, there's a requirement that I also get a peer review. And that's, a big four firm will look at a big four firm, regional firm will look at regional firm. And through these peer reviews, they often identify problems. Those problems are reported to the State Board of Accountancy, and then the State Board of Accountancy takes disciplinary action. And sometimes you look at those and you're like, what was the person thinking? They went to do the peer review, and when they asked for the work papers to support an audit report that was issued, there were no work papers. So they just signed an audit report and didn't do any work. And some of those things you're like, okay, this is just a bad apple. Okay, but sometimes you read things where the person just, overthought what they were able to accomplish. So they took on an engagement Meanwhile, they didn't have the appropriate technical competence to successfully complete that audit. I see that a lot of times, and I'm like, wow, that's a mistake that should absolutely be avoided. It's an avoidable mistake. We're going to see when we look at client acceptance that you have to assess whether or not you can successfully complete the audit. And the standards have no sympathy. They have no sense of humor about starting an audit, getting halfway out there and saying, oh, I can't finish this. I don't have the technical competence. So you'll see things like that in that CPA bulletin put out by the California State Board of Accountancy. It's a quarterly report. Towards the back of some disciplinary actions might not be a bad idea. Sometimes just peruse that a little bit.
I have another question. It seems like competitors are doing peer reviews of their competitors, and naturally a competitor would want to find something wrong with their competitor. So how do they balance that? Isn't that a conflict of interest? I mean, I don't know if there's a better way to do it, but
yeah, that's a good sense. What most is, I'm going to speak about, I shouldn't say most states, because if I do, that implies that I looked at the regulations for most states, which I have not. Okay, but I'm imagining that I'm guessing that most states are like California. So let me speak to California. Okay, with the footnote that I think most states are probably like this, without having looked that up. But in California, it says that if you're going to be auditing public companies, you must have a peer review, and that peer review must be done by a peer reviewer that is part of officially recognized peer review system. And then you look in that peer review system, the only one recognized in the state of California is the American Institute of Certified Public Accountants peer review system. And so in order to be accepted by the AICPA as a qualified peer reviewer, meaning you can carry out peer reviews, you have to go through a process of being evaluated and accepted by the AICPA. So I think, firms are going to be very respectful of not going around trying to, be, I'm looking for the word here, bad actors in that space of, going after their competitors and killing them, hitting them up with problems, or vice versa, going easier on them because they are being sort of regulated, if you will, by the AICPA in order to be in a position to do the peer reviews. Does that kind of help?
yeah, thank you.
Yeah, there's an official process there, but that's a good thought, good competitive spirit there. But yeah, that generally wouldn't be something that would happen. I think I kind of got into this last time. All of these things are sort of prayers, right? That everybody's going to act accordingly and act in good faith and that sort of thing. But hey, we see all the time there are bad actors there. But I think in that case, a person would be shooting themselves in the foot, because if you keep acting out in an inappropriate manner, they're just going to remove you from that program. Okay. All right, good. So we take a look at this question, and which element of the system of quality control strive to provide the firm with reasonable assurance that policies and procedures are operating effectively? Now you look at this and you say, well, okay, John, thanks a lot. You gave me that mnemonic, and any of these would fit in the help mnemonic. So this isn't so much what is following as an element of the system of quality control, but we're asking which element would achieve this objective of provide the firm with reasonable assurance that policies and procedures are operating effectively. And at the end of the day, it's that monitoring that's going to identify if an engagement didn't follow the standards. So we put all these structure in place, and then the monitoring ultimately is what will tell us whether or not this system, the other elements of help model, were doing their jobs with human resources, the leadership, et cetera. Question on that one? Okay, good. Let's go ahead and take a look. This one's a little easier in that it's just asking which of the following is an element of the system of quality control. And I say it's easier. I guess I'm making too much out of my silly little mnemonic, but right here, you could put help mon here and you'd blow up acceptance of clients right here is clearly the one that fits within that. And again, you know, you look and none of these other ones were obviously related to the quality control elements. An important role of PCAOB. Okay, obviously, right? Issuance of statements of Financial Accounting Standards Board. Well, that's the Financial Accounting Standards Board. Hello. Preparation and grading of the uniform CPA exam. That's the ICPA. Now, even though you apply for the exam through the state and you get your scores from the state, it's the American Institute of Certified Public Accountants that writes the exam, grades the exams, okay, and then they release the score to the state. In fact, there's always a day lag. Sometimes I have students that are freaking out. They see the day that the AICPA says that they're going to release their scores, and they start looking for their scores to be released by the state of California that day. And I'll get emails, you know, from somebody sent me an email 3 o'clock in the morning. I'm looking for my score and it's not there. So it takes one more day. Wait one more day, your score gets released by the state the next day. So the AICPA tells the state what your score was because they prepared the exam. They grade the exam. So preparation and grading of the exam is from the AICPA. Peer review of members of private companies practice section. That again is the AICPA. AICPA puts together that private companies practice section, and then they get approved to that system to be able to do the peer review of firms so that they can do the peer review of audits of private companies. So the regulation of the public entities, hello, public, okay, company accounting oversight board. Again, creation of Sarbanes-Oxley. Firm A performs audit of 60 public entities. Firm B, 120s. How often must each firm undergo PCAOB? Pretty easy question. Firm A is going to be inspected every 3 years. Firm B will get an annual inspection because they audit more than 100 firms. Okay, ethics. Again, accounting 302. Let me write that down just in case we're not familiar with the course that is here at Golden Gate, accounting 302. If you're going to be getting your license in California, they will require that you have a three-unit semester class in accounts professional responsibility, accountants ethics. And so we go into detail this area in this course, but let's just try to understand a little bit about ethics, and it kind of helps us to understand where some of the rules that you learn about in 302 come from. So let me start out with kind of a rough question. What do you think? Is it okay to kill? No? No. Right? Everyone says no. Okay. Well, what about if someone's trying to kill you? Is it okay to kill someone who's trying to kill you?
Yeah.
Yeah, it is. If you had to use deadly force to defend yourself, that would be accepted. In war, we kill. Okay, so we at the human beings have decided that murder is not correct or killing is not correct unless, and so we start to have sort of moral hazard type of exceptions to that. Okay, now you can go even further. You can say, well, look, there are different types of killing that maybe you did it by accident, etc. And we start to come up with laws that help us to carry out this ethical idea, etc. Right? And so I'm talking in the context of mega ethics, okay? But you also have applied ethics, okay? And then within applied ethics, you apply them to different fields, medicine, etc. Then you can apply that to business. And then under the context of business, you can apply that to different areas of business, accounting, okay? And so when we look at the rules, which you can kind of see at a high level over here, you have high level principles. Those principles translate into rules of conduct, and then there are interpretations of the rules of conduct. Now, the code of professional conduct is basically put together by the AICPA. Oops. Okay, sorry, buddy, didn't mean to draw an arrow on your head. Put together by the AICPA. Okay, now, how would we make sure, do you think, that CPA firms would follow the AICPA's Code of Professional Conduct? What would be a mechanism to see that CPA firms follow this? Because they're not required to follow. I mean, someone might look and say, well, I guess I don't have to follow the Code of Professional Conduct if I'm not involved with the AICPA. Give me a second here, guys. Forgive me. I always forget to put this in the right. Let me just end this real quick so I can put it in the right. Because otherwise it's going to keep changing that slide on me. Slideshow. Well, I'm just going to do it this way. I'm not going to make you sit here and figure out how I can put this here. So I'll just put it up here. How would we make sure that a CPA firm is following the AICPA Code of Professional Conduct?
Do they make their employees sign a statement saying that the employee has read it and will abide by it?
Well, the CPA firm would have engagement performance type steps to make sure that some of the elements of this Code of Professional Conduct are being followed. For example, principle is independence. Rules of conduct, I should not have a direct interest in an audit client, okay, direct investment in an audit client, no matter how small. So I can't own even one share of stock in an audit client, okay? So principle, independence, rule of conduct, they give us what? They give us something that says no direct personal ownership or no relationship. No direct relationship conflict of interest. I can't have, for example, my spouse can't be the CFO of an audit client, okay? But then you get into rules of interpretation. Rules of interpretation would sit there and say, well, okay, but what happens if the person is not involved in the accounting? So is it okay that my spouse is a truck driver for a trucking firm that I'm auditing? Well, yeah, as long as they don't also be the bookkeeper. But if they're not involved in the financial function of the company, then the interpretation rules and the rules of conduct would say, well, you're okay in that sort of a situation. So we have a high-level independent rule of conduct. Can't have a relationship conflict unless interpretation of the rules that individual is not involved in the bookkeeping. Now, the engagement performance rule would probably say I have to sign when I start any engagement that I don't have any impairments to my independence, and I would literally have to sign that at the beginning of the engagement. And then I would have to probably, well, in my years of the GAO, I don't know if other firms do this, every time period, every time I filled out my time card, I had to reassert that I don't have any impairments to my independence. So these would be engagement performance type things, quality control things that you would put in place to make sure that your employees, that the engagements were being carried on here. But how do I make sure that a firm is setting things up so that they're a code of profession, they're following the AICPA code of professional conduct. Because the AICPA really doesn't have any direct regulation over the CPA firms. And the way this is accomplished, guys, is most states, I know California does, again, I always say most states, I'm pretty sure it's the case. I haven't surveyed the states, so let me speak California. California, there is a requirement, the California Code of Professional Conduct mirrors the AICPA's Code of Professional Conduct. And then they even add on some additional things. So since the State Board of Accountancy regulates CPA firms, then they hold them to this Code of Professional Conduct that's put out by the AICPA through the process of the regulatory authority of the states. Okay. All right, again, we can have an entire course on this, but this is just to give you just a broad, a high level, 2 slides worth of information. Question. Okay, good. Looks like we're caught up with chapter 2, and I want to write down that it is 6:02. Okay, so I can tell Gracie that we finished chapter 2 at 6:02. That makes 6:02, chapter 2. Should be easy to remember. Okay, so let me go ahead, if there's no questions on any of that, and close out this one. And jump us into, I think we're okay to keep going, head on into chapter 3. Okay, so what we're going to do in chapter 3 now is we're going to start at the very beginning now. So we're kind of past, we've identified the standard, we know who's regulating us, we have a high level understanding of the audit report a little bit that we talked about in chapter 1 and 2 a little bit. And so now we're going to really start to flesh out some of the steps that we will be doing in an audit. And that's really going to be the focus of chapter 3. Chapter 4, I'm going to jump to chapter 6. We'll finish up chapter 5 as we head into our midterm. So our midterm, we'll have a few questions from 1 and 2, but really the rubber's hitting the road to a large extent here on how we're going to actually be doing audits here, starting with this chapter 3, starting with audit planning. Okay, then we'll get into, towards the end, discussion of materiality. Okay, and that'll set us up obviously for chapter 4 next time. All right, so let's just go ahead and you take a look at the various aspects of audit planning. Of course, we have to accept a client. We'll have some preliminary activities, and then we'll start to get into some of the planning of the audit. We'll really kind of talk a little bit about that here, the planning of the audit, but we'll get more into planning phases. There's various aspects of the planning phases in some of the later chapters, 3, 4, 5. Okay, so we're going to be forward focusing here, a little bit here, and then more of this in chapter, and we really start to dig into chapters 4, 6, and 5. We'll go in that order where we'll really start to dig into this part right here. Okay, but let's just go ahead and let's take a look at prospective client acceptance. Now, when you look at this, the key thing that we want to try to avoid is that we do not get involved with a client that lacks integrity. If you get involved with a client that lacks integrity, like I was mentioning in the Enron case, that firm is going to drag you down, or that client is going to drag the firm down. And that was the case in Arthur Andersen. Okay, but at a high level, okay, you may want to look at the financial information. You've got a firm that's maybe in a difficult financial position. That could be a motive for them to commit some sort of fraud, financial reporting fraud, stealing of resources, etc. You're going to want to avoid that client. Okay, you want to look at the integrity of the client management. Again, you want to avoid a client that lacks integrity. Is there an unusual business or audit risk? Maybe that client has a particularly difficult financial structure, or their product is a product that is difficult to understand. If they're a complicated firm. I was reading today there's a GAO report that I was looking at about the different vaccines and potential for different vaccines that they're coming up with. Well, look, if you're auditing a client that's coming up with one of those vaccines, what's the big client here in the Bay Area that's involved in that? Let's say you were auditing that client that I'm Gilead is the name of the firm. Well, you know, you just don't walk in one day, you know, you've done audits of grocery stores up until now, and all of a sudden, you know, you're going to be able to audit Gilead or something. So if there's particular business or audit risk associated with that because of the complexity of the entity, you need to consider that. Obviously, you need to be independent. You look for relationship bias. You look for investment bias. There are various biases that could affect your independence, okay? Do you have, again, the technical skills and knowledge? I used to hear people say, well, I like to dabble in, and they would talk about different types of clients they like to dabble in. I'm thinking to myself, okay, there's really no dabbling in auditing. You either know what you're doing or you don't. There is no dabble. You know, you may have some things that you do less than others, but you know, either way, there is no dipping your toe in the water and kind of halfway knowing an industry or something. Okay, determine if the acceptance violates any regulatory agency code of professional conduct. Is there a reason that I cannot accept this client due to a regulatory or code of professional conduct issue? Okay, now, when you look at this, one of the best ways to make sure that you are making sure that you're staying away from a client that lacks integrity is through communication with the predecessor auditor. And these have to happen before engagement acceptance. So before you can accept a client, you have to have these communications with the predecessor auditor. Now, I think you probably know, but let's just make sure we're clear with the term predecessor auditor. So let's say you have a client and you audited the client last year. I'm auditing that client this year. You would be the predecessor. I would be the successor. So the successor auditor has to have certain communication with the predecessor auditor. Okay, and it is mandatory that we make these inquiries, the successor make these inquiries before you can accept that client. So it is a mandatory requirement. We have to make inquiries to the predecessor. Now, when I was studying audit, what would always drive me crazy is they would say something's mandatory, and then they'd put something like this after that says client permission is needed, however, and I'd always get stuck in these chains of illogic or logic, whatever, where I'd say, well, wait a minute, if it's mandatory, how can client permission be needed? Because, you know, the client can't tell me not to do something that's mandatory. What's going on here? Well, there are rare exceptions where the client may have good reason that they do not want you to talk to the predecessor. So you're the successor auditor, you have to get permission. You have to get permission from your client to contact the predecessor to make these required communications. Well, what would be a good reason for them to tell you no? Maybe the predecessor was incompetent. Maybe the predecessor themselves had some ethical issues that gave the client concern. And now the client's counsel is saying to you, look, we're in litigation with this former client and with this former CPA firm, I should say. The client's telling you that, and we really think it would bias our case if you were to talk to them. You do some investigation, you look around that, and that could be reason not to carry out these mandatory pre-acceptance communications that you have to have with the predecessor. Okay, but assuming you don't have anything unusual like that going on, then you should make these inquiries. And when you look, remember, one of the key things we talked about on the previous slide is we want to avoid that client that lacks integrity, right? So let's just take a look. And when you look at this list, it's interesting that all of these really relate to avoiding a client whose management lacks integrity. This one, in fact, comes right out. Information that might bear on management's integrity. Disagreements with management over accounting principles. Again, audit procedures, et cetera. Again, getting into, well, is management a little bit shady? Are they trying to pick accounting principles in a manner that helps to make the company, distort the company's financial position, results of operations, et cetera, right? Are they trying to limit my audit procedures? I used to get annoyed in engagements where we would start to talk about different procedures we want to do. And then, the management would say, well, why do you have to do this? Why do you have to do that? And it's a lot of times I'd want to say to them, because in this room, I ask the questions and you answer them. That's why. Okay. You can't say that. Okay. But, a lot of times the client will be asking you that because they want to try to steer you away from a certain procedure that might uncover some sort of misappropriation or misstatement, et cetera. And so if you have those sorts of things, significant disagreements, you want to know that if the predecessor had that, you want to know that before you accept this client. Okay, what were the reasons for the change of auditors? Why are they changing auditors? Perhaps you've got a client that's a potential client that's opinion shopping. Hey, we thought that there should be a disclaimer of an opinion about something or a qualification of opinion or something, and the management just wouldn't accept that, and so they want to change the auditors. Okay, so you want to be able to avoid that. If there had been any communication with the audit committee, those charged with governance. We talked a little bit last time, audit committee as part of the board of directors, but it's not always the board of directors. Some entities, they don't call it the board of directors, but it's the same level. So they would come up with this more generic term, those charged with governance. And so if there had been communications about fraud, non-compliance with laws, illegal acts, that sort of thing, what were they? So again, when you look at this list, this 1, 2, 3, 4 here, I think you're seeing again, this is all trying to get a sense as to management's integrity. We want to do we want to ask these questions before we accept this client. We don't want to get down the road with them and then we start finding out that we've gotten involved with a management that lacks integrity, because again, that could bring down the whole firm, as we saw in the case of Arthur Andersen and Enron. Okay. Again, request management to authorize the predecessor, not an again, management, again, on that management has to authorize that, but we want to review the work papers of the previous engagement. But we don't just walk over to the predecessor and say, hey, we're the successor. Do you mind if we get the work papers? That's not how it works. It's a formal process. You ask the client to ask the predecessor to allow you to look at the work papers. And I don't know if you've ever been involved in that, but it's an interesting experience. And that often what they'll do is they'll assign a staff, the predecessor will assign a staff to sit there like a security guard. It's kind of like one of these things where the guy stands there all day, sitting there looking at you. Sorry, this is my little toys here, sits there watching you as you go through the work papers, et cetera, because those work papers are the property of the predecessor and they want to make sure that you're not taking authorized copies of those things, et cetera. And so you have to ask the client permission first before you can do that step. But that's also a step that you would do here as part of the acceptance of the client. Any question on this stuff? I mean, this is sort of the key elements here of what you need to do with acceptance of client. Okay, good. Let's come over then and let's take a look. And client retention. You accept the client. That doesn't mean that the client is exactly the same they were on the day that you accepted them. So each time when you're near the completion of the audit, or if there's been a significant event, change in management. Okay, you're on the engagement, all of a sudden there's this change in management. Well, should you continue with that client? Okay, and then if there have been conflicts over accounting issues, dispute over fees, okay, they can owe you a fee when you start the second year audit, but before you issue that report for the second year, they have to have paid you for the first year. Why do you think? Why would I have to have been paid for the first year before I can start the second year audit, but I can't issue my report until they've paid me for the first year. Let's say I've done year one, I've done year two. I start year two audit. Now I'm getting ready to issue the report, but they haven't paid me for year one.
You wouldn't be independent after if they didn't pay you.
Yeah, I'm not independent. Now I have a direct financial interest in the client, right? And so good, very good. So there would be a requirement that they pay me for the first year before I can issue the report of the second year. Okay, good. And that's something that's spelled out in the AICPA Code of Professional Conduct. And then the state of California has adopted that to their Code of Professional Conduct. Good. Okay. Now, preliminary engagement activities determine the team. Who are we going to assign to this engagement? Maybe we need some particular expertise, someone with a specific background. We need to have a balance of different levels of experience on an engagement. All of those things get into consideration. Assess compliance with ethical and independence requirements. You know, you will ask people to look and say whether or not there is some sort of conflict of interest. You will require your staff to disclose to you where they may have holdings. So you don't even assign those individuals to a potential client where they have holdings, that sort of thing. Okay, all of these things need to be done. Okay, all right, good. Now we have to establish an understanding with the client, okay, and that is done through an engagement letter, okay, and there must be a written engagement letter on every audit, okay. An engagement letter has to be written, and there has to be on every engagement. I shouldn't say audit, every engagement, regardless of the level of even if it's no assurance being provided, you must have an engagement letter. Okay, and that engagement letter is going to be signed at the highest levels of the organization. It's going to be signed by the CEO, CFO, members of the audit committee, etc. Okay, now the key thing that's going to be talked about in here is what is management's responsibility, what is the auditor's responsibility. So when you look, the engagement letter is really a contract that is signed by the auditor, signed by management, and it constitutes a contract as to the responsibilities. And so we make sure that I'm kind of doing this little thing because the four corners of the contract, okay, you've heard that before, that really defines what our responsibilities are, and there really aren't things that are outside that four corners, right? So we put it in writing, must be a written engagement letter on every engagement, whether it's an audit, whether it's a review, whether it's compilation. There must be an engagement letter, okay? And it is signed at the highest level of the organization by the auditors and by senior levels of management, members of the audit committee, et cetera, okay? Got to be written. Now, you look at this little piece up here is sort of showing you, okay, I kind of buried the lead there. I forgot that I had this little insert here, which shows that it was signed at the highest levels of the organization, chair of the audit committee, the auditor signed it as well. Okay, again, it's not, you know, you're not asking a junior staff to sign this. You're not asking, you know, an associate at the client to sign this. It's the highest levels of the organization. Now you take a look and remember we said that it's going to cover management responsibility and auditor's responsibility. So the nature of the types of things that are covered under the responsibilities of each of the parties that are assigned to this engagement letter are listed here. And again, this is one of those things that no one wakes up in the morning saying, okay, what are the management responsibility? What are the auditor responsibility things that need to be covered in an engagement letter? So again, I gave you one of my stupid mnemonics. And again, the only thing that makes my mnemonics memorable is how dumb they are. Okay, so this mnemonic is Chris Porta. And I don't know what a Chris Porta is. I've heard of port wine, and I don't know that they're particularly crisp, but whatever, okay? Chris Porta, it's so stupid now you can't forget it, okay? So let's go take a look and see what is covered in the engagement letter under management responsibilities and then auditor's responsibility. Management is responsible for the internal control. Notice we even say that in the audit report when we were looking at that briefly the other day. That's also called out in the audit report. So we want to make sure that everyone understands management, you're responsible for the financial statements, okay? Selecting the applicable framework, okay? The internal control, okay? So management is responsible for that. The applicable framework means, are we using US GAAP? Are we using international financial reporting standards? What exactly is the applicable framework? Okay, and of course, the internal control, compliance with laws. Management is responsible for that, okay? Now, representation letter. Sometimes this gets confusing because you're like, John, I thought we're talking about a letter here. Isn't this the engagement letter? What do you mean representation letter? Okay, well, the engagement letter, which is what we're talking about here, comes at the beginning of the audit. Okay, at the end of the audit comes this management rep letter. Okay, so auditors are kind of lonely people, and they want to make sure that they're always going to receive a letter from somebody. Okay, so what happens? At the beginning of the engagement, we have this engagement letter. This is laying out the responsibilities of management, auditor, it's essentially contracts signed at the highest levels of the organization. At the end of the audit, we want management to give us a representation letter. And the things that are in the representation letter are typically things that are hard to audit. For example, it is very hard to determine if there was any fraud on an engagement. Why? Because there's all kinds of steps that somebody who's perpetrating a fraud could take to try to conceal the fraud. So because of the concealment aspects of fraud, we make management put in a rep letter that if they know of any fraud, they've told us about it. If they know about any misstatements, whether caused by errors or fraud, they've told us about it. Completeness of information, what happens? It is very scary to sit here and have this be my audit report. And there's a potential whole world out there that has to be included in this audit report, right? And so under the idea of completeness, I make management tell us, you've given us complete information, complete access to records and everything that we need to complete this audit. We make them put this in writing. And we get this at the end of the audit. And again, it has to be signed by the highest levels of the organization, CEO, CFO, sign off that they have complied with what's laid out. And by the way, we'll talk about the management rep letter in later chapters when we talk about, I forget what chapter it is, when we talk about completion of the audit. We'll talk about that later, and you'll see, we'll talk more about the management rep letter, okay? Now what happens? It is mandatory that we get this rep letter. The auditing standard requires you must get the rep letter. If you don't get the rep letter, then you're going to have to either qualify your opinion or disclaim an opinion. You're probably very close to disclaiming an opinion, not even giving an opinion. Remember, we talked about that last time a little bit, disclaim an opinion on the financial statements. And so that would be problematic if we got all the way to the end of the audit, asked them to sign the management rep letter, and then they said, no, we're not signing it. Meanwhile, we have to have this in order for us to issue an unqualified report. And so now we're stuck here. We're like, well, we can't issue an unqualified report because they haven't given us the rep letter. And now they're going to say they don't want to pay us. And we've already done all this work. We're done with the audit. We're at the end of the audit. We're trying to issue this audit report. Meanwhile, we're being held up on the issuance of the audit report because they won't sign this stupid engagement letter. So, this stupid rep letter that comes at the end. So we make them put the engagement letter so we can sit here and say, you see this? You signed and you told us at the beginning of this engagement that you would give us this rep letter that comes at the end of the engagement. And if you don't give us the rep letter that you've already signed and agreed that you'll give this to us, we'll see you in court and we'll sue you for our fees. And this contract that we have in this engagement letter would have specified that you have to give us that. So now we're not going to issue the audit report and you're going to pay us our fees. So it's a way for the auditor to cover themselves to make sure that they get this mandatory requirement at the end of the engagement, they get this management rep letter. And we'll talk more about the details of the rep letter later, but we're going to specify that we have to get that in the engagement letter, okay? All information is made available. Subsequent events, we'll talk more about subsequent events later, but a subsequent event is an event that happens at the either can happen before the date of the financial statements, say year end, or after the date of the financial statements, but needs to be disclosed. If it happens before the year end, the financial statements need to be adjusted to reflect that. If it happens after the year end, but before we issue the report, it needs to be disclosed. Now, these are things that can be a little scary for an audit, because what happens? The world refuses to stop while we're doing the audit. So we're doing an audit, and let's say the year end is December 31st, and then a client has some sort of accident in one of their facilities, and the facility is destroyed. And maybe there's some injuries or something. And those things are going on while we're trying to complete the audit. Well, that would be something that would be considered subsequent event that happens after the financial statements. It would have to be disclosed. So it gets a little difficult to keep track of all these little things that might be going on that maybe the books and records haven't had a chance to reflect yet. So we ask them to put in the engagement letter that they'll tell us about these kind of things. And by the way, the rep letter affirms again at the end of the engagement, you told us about all those things, right? Okay. And then arrangements to meet with the predecessor. Arrangements regarding specialists. Okay, and the predecessor, we've talked about getting client permission for the predecessor, so we put that in the engagement letter. Specialists we'll talk more about tonight, but sometimes I'm going to need to engage someone that has a specialty outside of accounting to help me complete the audit. We would talk about that in the engagement letter. Okay, responsibility of the auditor, we have to plan. Okay, what are our obligations to provide documentation to other auditors? What happens? I may be auditing a subsidiary. And so what's going to happen? I'm considered the component auditor, but then there's someone who is the auditor of the consolidated statements. I may have to provide information to the principal auditor, the one that's auditing the consolidated, and I would have that would be written into the engagement letter that, hey, I'm going to have to provide certain information because I'm just auditing subsidiary A down here, but there's several subsidiaries that make up this company, and there's a principal auditor that's going to do the consolidation. I may have to feed information up them to support their report, and so that would be talked about in the engagement letter. Okay, restrictions on the auditor's liability. Okay, arrangements regarding the composition of the team, and then form and content of audit reports. Some engagements you don't even have a report. If we're talking about a preparation engagement, I'm not going to even have a report. Okay, if we're talking about a compilation, the report has certain specifications. We're talking about an audit, and we're going to be talking about that we're going to be giving an opinion. So you can see that there are some very specific detailed things that need to be included in the engagement letter, because again, it is the contract, and we don't want to get caught where all of a sudden someone's saying, well, wait a minute, you promised you do this, or you said you do that, or we're not responsible for this, we're not responsible for that. It's all in that engagement letter so that there's no misinterpretations of the responsibilities of the other party. Okay, Chris Porta, I don't know, guys. I'm not going to get any awards for my mnemonics. Okay. Any question though on any of that?
Professor, can you please explain one more time these restrictions on auditor's liability? And what are the restrictions here we need to think about?
You know, restrictions are more limitations on the auditor's liability. So we would probably be putting in there that the auditor isn't responsible for, illegal acts by the client, that sort of thing. Okay, so restrictions is probably not the best word. although it does help spell Porta, but limitations on the auditor's liability, we'll probably put in there. We're not responsible for illegal acts by the client, illegal acts by client's employee, that sort of thing.
Okay,
Okay.
all right, thank you.
Mhm. Okay, so a couple of little questions here to help flesh out a couple final points about the engagement letter. True or false, audit fee should not be discussed in the engagement letter, and costs should not be discussed. They absolutely should be. If the client's going to reimburse you for travel, that sort of thing, that's the kind of thing you want in the engagement letter. What are your fees? It's right there in the engagement letter. Again, we don't want to get caught off guard that something wasn't in the four corners of that contract. Okay. True or false? All audit engagements should have a written engagement letter. Yes, all engagements, doesn't matter if it's an audit, yes, obviously, but if it's a preparation, even though we don't issue an audit report, we'll still have an engagement letter, compilation review. All engagements are to have engagement letters. Okay, good. Now, here's my big moment. Okay, I want to try the poll. So we're going to try to do this question, and I'm going to see if you're paying attention. Okay, and so this is the big exciting moment. First time I've used the poll function here. So let's see if I can make this work. So which of the following matters generally is included in an auditor's engagement letter? Okay, and so I want to go ahead and try this. I'm very excited. Okay, so I guess I got to move this over a little bit so you can still see the choices. Huh?
We can move the window ourselves on our own screen.
Oh, you move it yourself? Oh, I see. Okay, please move it so you can see it. And then go ahead and make your choices. Isn't this fun? Well, I've got 2 of 14, 3 of 14. Who are these 8 people that haven't voted yet? Halfway there, guys. Good.
Is there a way to change my vote? Doesn't matter. Change my mind.
I don't know. I don't think so, but it's okay. I don't know. Can you change it?
No, it's okay.
It's okay. Don't worry. This isn't the actual exam. In the exam, you could change it. Definitely. Okay. The poll is completely anonymous, guys, so don't be shy. I'm hoping that the 4 people that haven't voted yet are not like, you know, at the beach right now. Okay, well, we got 12 of 14. We're about 2 minutes into this, so I'm going to go ahead and end the poll and share the results. Okay, so let's go ahead and let's take a look. And of course, there was no E. You know, that's not a concern, but let's take a look at, I'm going to move it on this screen here for myself. Okay, so let's go ahead and take a look. And let's start at D. Okay, a few folks, 1/3 of us chose D. The auditor's responsibility to search for significant internal control efficiencies. Okay, we did have auditor responsibility, so I can see why some of you chose D, but there was no mention of auditor's responsibility to search for significant deficiencies, and I guess it's not going to let me back to the previous slide without closing the poll, and I don't want to do that yet. So no, auditor, first of all, auditor may give an opinion on the internal control if we're doing an audit of a public company, okay? But we are never going to be responsible to search for significant deficiencies in internal control. What we do in an audit is we have to understand the internal control in order to plan the timing, extent, and nature of our audit procedures. And in that process, we may identify problems with the internal control, but we are not required to search for them. Remember, when you look at the opinion on the financial statements, it is simply saying that we give an opinion on the financial statements. And if we were auditing a non-public company, we don't even have to give an opinion on the internal control. So even though we do have auditor responsibility as one of our main areas of engagement letter, nowhere in there were we talking about searching for significant deficiencies in internal control. Management's vicarious liability for violation of laws and regulations committed by the employees. Okay, no, we're not going to say that management is responsibility for liabilities by their employees. That may be true. I mean, if you know, the employee parks the truck somewhere and they get a ticket, probably the management's going to have to pay that ticket, okay, because they're the owner of the truck. So they would have a vicarious liability for violations of laws and regulations committed by their employees. But that's not something we put in the engagement letter. Now, we may want to limit that the auditor is not responsible for violations of law, but we're not going to be putting in the engagement letter that management is responsible for things that their employees do. That's none of our business. That's between management and their employees. Factor to be considered in setting preliminary judgments about materiality. We got a pretty good response on that. No, that's not something that's covered in the engagement letter. We will have factors that we'll consider in preliminary judgments about materiality, but nowhere in that engagement letter do we have, and remember, this is what's in the engagement letter. Management's responsibility for the fair presentation of financial statements. Yeah, okay, about a third of us got that right. So we were pretty good here that what, about a third of us, about 60% of us were in the ballpark of auditor responsibility, management responsibility, but the best answer was the one that had the most detail here. Management responsibility was the most precise, probably a better word for me to use. Management's responsibility for the fair presentation of financial statements. And I'm going to close this poll now so that it'll let me back my slide up. I think that's the reason it wasn't going to let me. Or is my clicker going to start doing a number on me? There it goes. Okay, if we go back, you may want to close off your the poll at this point, but you can see that what management's responsibility for the financial statements was clearly spelled out there. Okay, but you take a look, there was no discussion of the auditor searching for deficiencies in internal control. There was no discussion of management's vicarious liability, and there was for illegal acts by their employees, and that's something that may be the case, but we're not putting that in an engagement letter. And then there was nothing regarding talking about preliminary assessments of materiality. That's something that we may do, we absolutely will do, but we're not putting that in an engagement letter. We're not dragging management through the nerdy audit things that we're going to be doing as part of our initial work. Question about any of those? So the correct answer is A, right? Question? Okay, good work, guys. Let's go ahead then and take a look at a couple things that are in the engagement letter, okay? And we've already sort of seen some of these in that previous slide I had, but we're going to have to call out an engagement letter if we are going to need specialists or if we are going to be using the client's internal auditors. Okay, so let's sort of start to look at, or we will be looking at these two areas in detail here pretty quickly. Okay, so let's just go ahead and take a look at internal audit function. So what happens? Internal auditors, okay, and I'm going to go ahead and do a little, squeeze in a little graphic here. This is our internal auditors, IAs, internal auditors, and the internal auditors will report directly to the board of directors, okay? That's BOD. Internal auditors report directly to the board of directors. Now, here's what internal auditors are supposed to do. They're supposed to look, and let me back up. Internal auditors might look at the operation of the entity, okay, and that happens frequently, but a smart company, potential client, a smart client, will also have their internal auditors looking at their system of internal control of financial reporting as part of the monitoring aspect of that internal control. And so what they're doing is they're looking to see that the entity's internal controls are helping to ensure, and it could be compliance, it could be company operations, but the part that we would be interested in is where the internal auditors help to ensure through the monitoring process that the company's system of internal control of financial reporting is working adequately. So these are individuals who are inside the company. They report directly to the board of directors. So if they find deficiencies, they are to report those directly to the board of directors. Now, are internal auditors independent? That's a question.
No.
Good. Good. They are not independent. They are employed by the client, right?
Mhm.
Okay. So they are not independent, but can we use any of their work? I mean, they're there every day. They're looking at the internal control, et cetera. Can they assist us in understanding the internal control, in documenting our understanding of the internal control? And the answer is yes, they can. Okay, but we have to be satisfied as to their objectivity and their competence. So if you saw an internal auditor and you looked at an org chart and that internal auditor is reporting directly to the board of directors, would you be satisfied with their objectivity? You look at an org chart, they show that the internal auditor reports directly to the board of directors. Would you be satisfied with their objectivity? Huh?
No, because that's their boss. No, because that's their supervisor or boss.
Who do you want them to report to?
That's a good question. I don't know.
Okay, well, good. I mean, we're learning here, guys. The answer is yes. I would be satisfied if they're reporting to the board of directors. Now, sometimes what you'll see is a little dotted line. I'm trying to do a dotted line. Okay, you'll see a little dotted line to the CFO because their performance evaluation, their pay, et cetera, may be determined through the CFO. So the CFO could sort of function as their quote unquote, their boss, et cetera, but their reporting line is directly to the board of directors. So that they have a direct line there where they can issue their reports to the board of directors. But board of directors sits there and they all of a sudden get a report from the internal auditor saying, hey, the internal controls ain't making it, then aren't doing what they're supposed to be doing, then it's the board of directors' job to get back into management and say, hey, these things need to be corrected. And trust me, these days with Sarbanes-Oxley, boards of directors have no sense of humor about problems with the internal control, right? They are going to insist that those issues be corrected. So we would be looking for this sort of thing, direct access to the audit committee and determining the objectivity, okay? Competence is what? Do they have the proper training, the proper level of education, okay? Those sorts of things. I mean, if you have an internal auditor who has spent some time as an auditor, maybe a CPA, those sort of things, that's going to give you a much higher level of satisfaction regarding their competence. Okay. All right, good. Now let me ask you this. Can you share, as an auditor, can you share any judgments? Any judgments with the internal auditors? Can you go to say to the internal auditor, hey, why don't you assess the risk of material misstatement on this engagement? And we're going to get into what that means later, probably next chapter. Why don't you assess how much risk we're taking on this engagement? That's a judgment, right? Can you share judgments? Can you tell the internal auditor, you know, you take the wheel on this one. I'm going to go ahead and I'm going to be a passenger in the back seat. And you go ahead and I'm going to sit in the passenger seat here and you drive for a while. Let's see where we end up. Do you think you could do that?
No, because then you lose impartiality.
Yeah, you lose your independence, right? Because now you turned over an important judgment to someone who's not independent. There goes your independence car off the cliff, right? Just to take that analogy beyond where I probably should, okay? But you're going to run into a problem with your independence if you share judgments, okay? So do not share judgments, okay? And it's one of those things that, you know, since you're a baby, they've been telling you, share with your brother, share with your sister, share with your friends. When it comes to judgment, do not share judgments, okay, with the internal auditors. So if you look at this next slide, should we do the poll again, or is it just a little silly at this point? Which of these judgments can you share with the internal auditors? Assessment of inherent risk, assessment of control risk. What's the matter? It's too easy for you? Okay, good. Almost everybody's picking D, guys. I won't make it go. Oh, wait a minute. Wait a minute. We're getting a couple other choices here. This is exciting. Okay, I won't make everybody vote on this one, guys. It's what? It's clearly what? Well, I don't know how clear it is, but the choice here is going to be D, okay? And let me just go ahead and end the poll so I can circle the right choice here. Almost everyone got it right. Okay, so no, you cannot share any judgments. So the key thing here, and it might be a little confusing for you because you're saying, well, John, I don't even know what assessment of inherent risk is yet. I don't even know what assessment of control risk is. But the key thing here is what, and we haven't talked about those yet, but which of the following judgments, the key takeaway here is you do not share judgments. You don't let them take the wheel. Okay, judgments. How fast we're going to drive, how quickly are we going to turn corners, you know, how far are we going to drive. That is not the decision of the internal auditors. The independent auditor makes that decision. And in this game, you are the only one that's the independent. They are not independent. They are not considered independent. Question on that? Okay, good. Audit committee. Audit committees are required under Sarbanes-Oxley, section 301. Guys, you don't need to memorize sections of Sarbanes-Oxley. There are various sections of the federal statute. I think it's like section 200, for example, talks about criminal penalties for companies that engage in fraudulent financial reporting. 301 talks about issue of the audit committee. You hear about section 401 or section 404 all the time. That's the part that talks about our responsibility for internal control in a public company and issuing the opinion on internal control when we audit a public company. So various sections but it's 301 that talks about the board of directors and the audit committee, and thus the board of directors audit committee is going to want those internal auditors to be protecting their interests, because they could be personally liable for problems with the financial reports. Okay, and so there must be somebody on the audit committee that has a understanding of accounting, auditing, that sort of thing. Okay, now they are directly responsible for overseeing work. Okay, must pre-approve all audits and non-audit services provided by its auditor. Excuse me. So if there's going to be some additional work that maybe you're doing outside of your audit of the financial statements, you can't just make a deal with management and say, oh, okay, we'll do that. That's got to go back through the audit committee, because they want to make sure that the audit committee is completely in the loop as to any services that that's being provided. Okay, and they are ultimately the ones that have the authority to engage the CPAs. So you're really working for the board of directors, the audit committee. If you upset them, you've got a problem. Okay, although you probably don't want to be upsetting anybody in management either, but ultimately the independent auditor is hired and fired by the audit committee. Okay, sometimes I'll get a question where folks will say, well, what happens if they don't have an internal audit staff? Let's say that the entity isn't big enough to warrant an internal audit staff. And those internal audit functions should, by the way, be being carried out by members of an audit committee, or a member that constitutes the audit committee. So those internal audit functions, even if there isn't an official internal auditor, those functions should be carried out at the board of directors level. Okay. Okay, related parties. Let me ask you a question. Is it okay for a company to have transactions with related parties? Let's start with that.
Yes.
Yeah, it's okay. Okay, so there could be situations where maybe the company has loaned money to their officers. I've seen in not-for-profits the opposite happen, where there's contributions made by individuals who work for the non-for-profit at a high level, and they also provide contributions. So these sort of things happen all the time. We could have a transaction with a subsidiary, right? So it is okay to have transactions with related parties, okay? But those related party transactions must be disclosed. If they must be disclosed, then it is responsible for the auditor. The auditor has a responsibility to make sure that they are following the FASB topic. You can see there that those are being disclosed. So that means that we're going to have to what? We're going to have to know who the client's related parties are. So what would be a good way to find out who the client's related parties are? Let's say you wanted to know who I'm related to. What would you do? Say, hey, John, who are you related to?
You could do a background check.
Yeah, you could do a background check. Basically, what you could do is look at SEC filings. And there's a requirement in SEC filings that I have to disclose to the SEC who my related parties are. So you ask the entity, hey, give me your SEC filings of who your related parties are, okay? And I kind of gave the answer by accident when I said, hey, you could just ask me. So my point of who I'm related to, right? I should know who I'm related to. So you do that. You literally ask management, give me a list of any related parties. Okay, now, what do you do with this information? You've identified related parties by reviewing SEC filings. You've asked the client to give you information about related parties, etc. Now what do you do? Because you want to see if they've had transactions with the related parties. Well, what you do is you provide that listing to your staff. Here's the listing of related parties, okay? And then the staff may be doing a different, an audit procedure that is not specifically designed to identify related party transactions. They're doing an audit procedure to test accounts payable, accounts receivable. And when they see this account receivable, they are to look at that transaction where they're auditing account receivable to see if that name appears on the related party listing. And if it does, now we know we have a transaction with a related party, and we would look to see that the appropriate disclosure about this related party transaction was provided. So the procedure that you do is really done in connection, in conjunction with what? A completely different procedure, say, looking at the accounts receivable, looking at the accounts payable, loans receivable, loan payable. You're reaching those against the related party listing, and then you identify that transaction, and then you want to see that it's properly disclosed. Now, what happens if you identify a related party that management didn't tell you about? How happy would you be? Let's just do the little face thing, okay? Now, I'm going to go ahead and I'm going to put the eyes and the nose of the auditor up. Should I make this a smile, a frown? How happy? Yeah, we're none too happy. In fact, we're probably kind of mad, right? Let me put some eyebrows on this.
Would it be a finding?
Huh?
Would it be considered a finding?
Well, what the auditor's not happy, and the finding would be, hey, you didn't. Well, let me just a little bit. This is a little bit nuanced. I'm not dancing on the answer. We would be then expecting that they disclose that, right? Because again, remember, we're auditing the financial statements, right? And we're sitting here and we want to make sure the related party transactions are disclosed. So we identify a related party that they didn't tell us about. And I'm thinking there's a high potential that that related party transaction that we have identified wasn't disclosed, right? So first thing, we're going to make them disclose it. But we're starting to get into management integrity now. Remember, we did that at the beginning of the engagement, but you don't close your eyes as to their integrity as the engagement goes on. They should know where their related parties are. And so we would probably start inquiring to them, why did you not tell us about that related party? What was it that happened exactly that caused you to accidentally not provide us a related party? So remember, we talked about professional skepticism. That's why I kind of put the eyebrows on this auditor now, because now we're like, wait a minute. That's like me saying, you say, hey, John, who are you related to? And I said, well, there's Herman, and there's go through my siblings' names. And then I forget to mention my sister. And then you find out I have a sister. Well, okay, how do you forget that you have a sister? Okay, so they really should know who their related parties are. There should be no problem for them to give us a good list of related parties. And if we start seeing that we find a related party and they didn't tell us about it, our professional skepticism alarms start going off, and we really want to understand what happened that didn't allow you to identify this related party, that ended up in it not being properly disclosed. So we're not too happy if we find the related party that they didn't tell us about. Okay. The other thing you would do, you could do some procedure. This is probably designed more towards something that you do anyway to review significant unusual transactions. And then from there, you might look to see, well, maybe this is a related party. For example, if a client gave a loan to a party and they charged them, say, less than usual market rate of interest on that loan, why would you do that? If it's an arm's length transaction, why are you giving this particular customer a break on the interest rate? It's probably a related party, right? And so you look at something like that, it's an unusual transaction. You're looking for those anyway. You're scanning for unusual transactions. Anyway, you find this one, huh? Why was this loan significantly below interest that would be, provided in the market? Oh, that's right. That's our related party. Oh, well, why didn't you tell us that was, you don't know that that's a related party, etc. Okay. Okay, so again, it's okay to have related parties, okay, but related party transactions, they have to be properly disclosed. And again, the best way to get that is the two procedures that I would say would be the top. Make management give you a list of related parties and provide that to the staff, so when they're performing transactions or audits over other transactions for other purposes, they're also looking against that related party listing, and then looking at SEC filings to see who they've called out to the SEC, who their related parties are. Okay, what time do we got? I'm looking at it's about 7 o'clock. I think it's probably about time for a quick little break, guys. So why don't we go ahead and take about 10 minutes and we'll come back and pick up right here, okay? So we'll get back about 7:10. Shivani. What's up? No problem. Okay, guys, we're gonna go ahead and get started back. And so what this particular slide here is talking to us about is if you have a consolidated entity that has various subsidiaries, various locations, et cetera, you're going to allocate your resources based on, and you can see that we're basing that on the relative risk of these different segments, if you will, of the business, the company, different subsidiaries of the company. So if you have one that is more risky than another because of certain technological reasons or certain difficulties in financial accounting procedures, economic factors, et cetera, you'll look at all those and decide what risk to assign to these various subsidiaries. And of course, you'll offer more audit resources or allocate more audit resources to those areas with higher risk. Okay. Now, what they don't say on this slide is layered on top of this is the notion we're going to talk later about materiality. But of course, materiality is also consideration. So if you have different pieces of the consolidated financial statements and some pieces are bigger than others, and from a dollar standpoint, then you're going to consider that as well on top of the relative audit risk associated with each of these. So if you have a low risk, smaller dollar amount particular subsidiary, you're probably not going to provide as much of your audit resources towards what an obvious higher risk, larger from a materiality standpoint. Okay, so it's really risk and materiality that you think about as you try to assign audit resources where you're dealing with a consolidated entity that has different segments, subsidiaries, et cetera. Okay. Okay, now we mentioned a little bit specialists, right? In the engagement letter, if we were going to have to use a specialist, we would want to put that in the engagement letter. So what do we mean by specialists and why would we be using them in an audit? Okay, specialist has an understanding of an area outside of accounting auditing. The auditor is seen as the person with the specialist in accounting and auditing, but it could be that we need to invoke somebody that has a specialty outside of accounting and auditing. For example, I was on an engagement years I was working with the Government Accountability, GAO. I was assigned to audit the, be part of the team that was auditing the U.S. Forest Service. And so one of the items we look at on the balance sheet is the inventory, the key assets, the inventory. Well, what's the inventory for the U.S. Forest Service? It's trees, it's timber. And so they disclose that or report that on their financial statements and how many board feet of lumber there is in the forest. Now, how do I know how many board feet of lumber there are in a forest? I'm an accountant. I'm not a silviculturist, is the specialty that you look for in that situation. So what happens? You could bring in a specialist that could look at the general health conditions, size of the trees, et cetera, and give you an estimate as to how many board feet of lumber there are on that forest. Compare that to what the client, in that case, the Forest Service, is reporting. And that would be how you use the specialist to help support your opinion on the financial statements, at least related to the inventory line item, okay, asset. Now, when you're doing something like this, okay, is it okay to use a specialist that is related to the client? And the answer is yes, you can use a specialist that's related to the client. Now, you look at this, and if you look at the standards, they'll say, hey, it's better if you have a specialist who's not related to the client, but they allow for a specialist that is related to the client. And a lot of times the stuff that's hard to understand with auditing is, well, we have this rule and then we have this exception. The exceptions get hard to understand. When you think about the Auditing Standards Board, okay, that's the part of the AICPA. I think there's about 15 members on that Auditing Standards Board. They bring in actual practicing auditors. So it's a part-time board. They bring in practicing auditors from different levels of firms. So they have some of the big multinational firms, national firms, regional firms, and they all come together. I think they used to give them a trip to New York. Now it's, I think, in New Jersey somewhere. But they bring these individuals together and they help come up with the statements on auditing standards that constitute the standards that we follow when we do the audit. And there's always seems to be an exception in there for things because you have practicing auditors that maybe have been in a circumstance where they couldn't do the ivory tower rule, which is, hey, get a specialist that's unrelated. And I'll give you my own personal experience in auditing the Forest Service. We don't have another silviculturist laying around, so you use the one that the Forest Service has on premise, okay? But you'll probably want to take some additional steps to make sure, and you may recognize these terms from our discussion of the internal auditors, that you're satisfied as to their objectivity, okay? Their objectivity, and then we're also going to want to look at their competence, okay? So you take a look at what we're saying here on this next slide, and when you're dealing with specialists, you're interested in their competence, their objectivity, okay? Now you take a look, and let's see if I can get my, for some reason, I'm somewhat limited on my pens here. I'm not quite sure why I can't get all my pens, but I think it has to do something with the taskbar for Zoom, giving me some problems too. But anyway, when we look at the competency and objectivity, we say generally specialist who's unrelated to the client will provide the greatest assurance of reliability, although auditors should inquire about relationships, okay? A specialist who's related to the client may be acceptable. That's the exception. So you're looking for a specialist that is unrelated to the client, but you could use one that is acceptable because, and frankly, they're thinking maybe you're looking at something so unique, okay? Go back to, you know, some of these companies are developing vaccines or whatever. Their area is so unique. There is no other specialist that can give you any kind of assurance as to what's going on, okay? And so what do? You use a specialist, but then you're probably going to want to make sure that you perform additional procedures to be satisfied with their objectivity. So again, okay to use a client that's related to the specialist, but you may want to take additional procedures to make sure that you're satisfied as to their objectivity. And then competence, again, gets back to the issue of their level of education, their training, that sort of thing, okay? Now, agreement with the specialist in writing, the nature and scope, what's the specialist going to do for you, okay? The specialist needs to understand what the auditor is doing. So you're going to sit down and explain to them how you're going to be using the work that you're going to be getting from them in supporting your opinion. Okay, what will be the communications, etc. And then again, particularly, I think if you're, using a specialist that is related to the client, be aware of any confidentiality requirements, etc. Okay, so objectivity, competence, written agreement with the specialist. Okay, now let's say that you ask the specialist to give you some information, and the specialist's findings help you determine that the client did not properly account for something, did not properly disclose for something. What are you going to do? Well, if something isn't properly accounted for or disclosed, the financial statements are not in conformity with the GAAP as a result of finding the specialist, then we're going to deal with a qualified or adverse opinion, right? Remember we said last time, you see some problems, you don't like your buddy's shoes, you're going to issue a qualified opinion. You don't like their whole outfit, adverse. It really depends on the pervasiveness of the issue, and in this case, that the specialist found. Or if there's some sort of scope limitation, unresolved difference between the specialist and the auditor, then that could result in a qualified or disclaimer of opinion. So again, remember, we said, hey, if your buddy says to you, tell me by the sound of my voice how my outfit looks, and you say, no, I have to disclaim an opinion because I can't perform the audit procedure. Well, if you try to invoke the specialist to help you and you end up throwing up your hands and saying, hey, this specialist is not giving me the information I need here, then you may need to disclaim an opinion. Okay, so if that happens, you're giving something other than an unmodified, unqualified opinion, then you may refer to the specialist in your report and indicate that the specialist findings is the reason that you've had to qualify adverse disclaimer report. So you mentioned your opinion. So you mention a specialist if, as a result of the specialist findings, you've had to give a qualified opinion, give an adverse opinion, disclaim an opinion. Okay. Now, let's say the specialist comes back and says everything's fine. Yes, they have properly given you the estimate. The management has made a good estimate as how many board feet of lumber there are in this forest, whatever it is. Then if that's the case, then the auditor will express an unmodified, unqualified opinion with no reference to the specialist. Okay, so I know there's a lot of underlining on here, but key things on this slide. You don't mention a specialist if it's an unmodified, unqualified opinion. That's that last sentence. You don't have to mention a specialist. If you have determined for some reason that the financial statements are misstated or there was a scope limitation as a result of your interaction with the specialist, yeah, then you're going to issue your qualified, your disclaimer, your adverse opinion, and you'll call out the specialist at that point because, hey, it was the specialist was the reason that I found this problem. Okay. Question on that. I know that sometimes gets a little bit crazy in there. We're good? Okay. All right, good. So you guys, everybody's still awake? Okay. So let's go ahead and let's take a look at this question. We'll see how this works here. When auditing Vandalay jewelry, Constant CPA was not familiar with the quality of the cut of the company's precious jewel inventory, right? Now, I don't know. They all look like shiny pieces of glass to me. How do I know which one is, you know, this valuable jewel versus another, right? To address this shortcoming, Constance hired Beans, an expert in jewel valuation, to assist as an audit specialist for the inventory valuation. Should Constance refer to Bean's work in the audit report? You can see the answer, but let's just go through these. The use of an audit specialist need not be mentioned if the auditor decides not to take responsibility for the audit specialist findings. That's nonsense, okay? You don't take responsibility for the specialist findings. They are responsible for their findings. So sometimes students say, well, what's wrong with this first one? What's wrong with this? It's silly. It's dumb. Why would I hire a specialist if I'm going to take responsibility for their work? They're the specialist. They're responsible for their work. Okay, let's take a look. Should we mention refer to the specialist in the audit report? Let's look at the last one. Yes, the auditor should mention the fact that the audit specialist was used. No, I only mention it if the specialist findings indicate that there was a problem in the financial statements and I had to qualify or adverse. Okay, let's take a look at, I guess what would be the second to the bottom item C. The auditor's report should mention the audit specialist only if Vandalay agrees with the audit specialist findings. No, if I agree, I don't mention them. So the answer is clearly B here, because there's a green arrow next to it. The auditor's report should mention the use of the audit specialist only when the audit specialist finding affect the auditor's conclusions. Yeah. If you get to the point where, as a result of the specialist findings, you're going to have to qualify, modify your report somehow, qualify, adverse, disclaimer, then you mention a specialist. If it's an unmodified report, you don't mention a specialist. There's no call out of, hey, they're responsible for this, I'm responsible for that. It's as though you didn't even use the specialist. You don't bother the reader of the report the fact that the specialist was involved if the specialist findings do not require you to modify your report somehow. Question? Good, let's go ahead and take a look at supervision, okay? And basically, when we talk about supervision, we're really talking about the partner level, okay? So even though we saw in some of our earlier slides that supervision can happen at the senior level, and it does happen at the senior level, when we talk about supervision of the audit, we're talking about the partner level, the way this slide is talking about. So informing engagement team of their responsibilities, okay? Identify and communicate audit issues, review the work of the engagement team, even though this steps of review and whatnot would be being done at different levels of the organization. What they're talking about here is ultimately it is the partner's responsibility to make sure that the audit is properly supervised. Okay. Okay, now we're going to talk more about this, but this ends up being a very important slide. And we're going to talk more and fill in some of this as we go into some of the later chapters here. Next time, chapter 4, we'll really get into this, okay? But there are some procedures that have to be performed on every audit, and some procedures we can maybe do or not do, okay? So we must always do something called risk assessment procedures. We must also do substantive procedures. Test of controls only happen, okay, for an audit if we think the entity has effective internal controls. If we don't think the entity does not have effective internal controls, we don't have to test the controls. So the standards don't have us going and testing ineffective controls. Okay, we test controls that we think are effective. So if the entity has ineffective controls, then we do not have to test them. That's the case for public, non-public companies. Okay, now for a non-public company, the standards also give us the option to not test the controls if we think that it would be inefficient to test the controls. They provide a provision for us to go directly to our substantive testing, which we must always do if we've determined that it would not be efficient to test the internal controls. We don't have that option for public companies. For public companies, if you think the controls are effective, then you have to test those controls, because testing of those effective controls would allow you to then have the evidence you need to support your opinion on internal control, which under section 404 of Sarbanes-Oxley is required. Okay, so we put sometimes over tested controls. If we're talking about what ineffective controls, I don't care if it's a public, non-public company, you don't have to test ineffective controls. So controls ineffective, what am I testing? How ineffective it is? I don't have to test an ineffective control. If the entity is non-public, I don't have to test the controls if I determine it would not be efficient to test the controls. Okay, I don't have that option for a public company. If I've identified effective controls, I must test them. We're going to get more into this, but is there anything I can elaborate on that right now? Okay, you sure? Okay, good. Now, when we are planning our audit, we must have a written audit program. We must have a written audit program. Okay, and when we write our program, we will write them in the form of management assertions. Now, I'm not going to get too much into assertions tonight, but I want you to understand that this is a big part of this class right here. Financial statement assertions. Okay, I know that when we talk about financial statements, we're used to thinking, okay, assets on the balance sheet, liabilities on the balance sheet, stockholders' equity, revenue on the income statement, expense on the income statement, and we have to make sure that all those numbers are correct. That's what we do in an audit. You need to start to lift yourself up from that and start to think about assertions. Okay, so management lists an asset. I don't know, building, equipment, asset on their financial statements. They are asserting to you that that asset exists. When they put liabilities on their financial statements, they are asserting to you that those liabilities are complete. Okay, and so we design our procedures not around, and even though when we study it, guys are going to be saying these are the procedures for inventory, these are the procedures for assets, revenue, whatever. That's the way we present the information to you. But I'm always going to be pushing you back to no, it's really an assertion. When we're looking at inventory, we're looking to see that inventory exists. We're looking to see that inventory is complete. When we look at revenue, we want to see that it occurred. Okay, so then we design our audit procedures in our written audit program around the assertions, okay? And so our audit procedures are always put around assertions. For example, when we look at the existence assertion, the classic procedure for existence is confirmation. So if we were talking about accounts receivable is an asset. We want to make sure it exists. We would do confirmation. Okay. If we're talking about completeness, we want to make sure that everything that should be listed is actually included in the financial statements, and we'll identify audit procedures that will help us with that assertion. Okay. So again, we're going to get more into this, but I just want to give you this sense right here of how we would use confirmation to test the existence assertion. Okay. Confirmation is a classic step for the existence assertion. So what happens? I'm sitting here and I have my financial statement, right? I'm auditing the financial statement. I have accounts receivable. They sit there and they tell us, hey, $10 million accounts receivable, right? Okay, now what am I going to do? I'm probably going to go to the subsidiary ledger of the client and pull out some of my client's customers. Okay, say Jones, let's say Jones is a big one. Let's say Jones accounts for $5 million of that total account receivable balance. Well, I'm definitely going to send a confirmation to Jones. Okay, so here's Jones. Okay, and I'm going to ask Jones to sign a confirmation saying that he owes $5 million. He's going to take that confirmation and he's going to send it straight back to the auditor. This is the auditor up here. Okay, now I've just confirmed what? I've just confirmed the existence of a $5 million account receivable because why? I went from the financial statements and I got supporting documentation that came back to me that said, yeah, Jones is really out here. Okay, now when you look at a procedure like this, and this procedure helped us with, I guess this example of an individual customer, helped us with the confirmation of our accounts receivable, that individual customer, that gave us some evidence from outside the entity that Jones really existed and he owes $5 million, right? Now, is this properly valued? Did they value this correctly? They valued $5 million. Jones came back and signed and said, yeah, I owe $5 million. So is $5 million the correct value? That's a question. Did we value this correctly? I know he exists because he came back and he sent this back to me, directly back to me. I'll wait. Okay, one thing here. Okay.
Jones have gotten it wrong, gotten the valuation wrong.
Well, the valuation was $5 million for this particular receivable. He came back and said, yes, I owe $5 million, right? Jones came back and said, I owe $5 million. But do we know that $5 million is the correct value for this? I know he exists, right? I proved there's someone out there named Jones who agrees he owes the company $5 million. But should this be reported at $5 million?
Could it be different based on when the financial statements will compile?
Well, financial statements, you know, I mean, I'm assuming there's other people down here. I'll just put another name. We'll say Frank's. Okay, I don't know. Also owes $5 million. Okay, so, you know, it's totaling up to 10 million. Jones said he owes 5 million. Is 5 million correct value for Jones? He said he owed 500. He says he owes 5 million. Is that the correct value for Jones?
So if Frank also say that he owes 5 million.
Okay, let's say we send it out to both of them, and both Frank and Jones both say they owe 5 million. Is 10 million the correct value for the account receivable?
Yes.
Let's say we sent out confirmation to the two customers, and they both come back and say, yes, I owe 5 million. Now we proved they exist, right? Because we sent the letter to them, they sent it straight back to us, right? So we had direct communication with the individual customers, right? Is 5 million the correct value?
Allowance for doubtful accounts.
Right, who said that?
Davi?
Right, Davi, that's exactly where I'm going with this. Very good. Okay, what's happening? I don't know that they can pay this. Okay, I would have to do another audit procedure at this point to determine if they can pay this. For example, I might do an aging of these account receivable, and maybe it turns out Jones hasn't paid for 180 days. Well, yeah, Jones is saying I owe 5 million. Good luck getting it from me because I'm, in bad time right here. I can't pay that. So you would have to do a separate procedure, right, for the valuation, which is another assertion. Okay, so we line up audit procedures with the assertion. So the assertion confirmation helped us with the existence assertion. Good, got existence. Valuation, different assertion, different procedure. Now I'm probably going to start to get into aging of account receivable, looking at how they're, Davi, like you said, determining the amount that goes in the allowance for doubtful accounts, et cetera, right? And we'll get more into specific procedures around sales and accounts receivable and stuff. The main takeaway from this discussion right here is what? Written audit program. Got to have a written audit program, right? Part of our planning on every engagement. And when we write that program, we are calling out audit procedures that help to prove the financial statement assertions, okay? And if we have an assertion, we're going to have a different procedure for those different assertions. Question? Okay, good. Good discussion, guys. Okay, good. Now, in the planning phase, okay, remember we're talking about planning. Okay, we're going to do something called analytical procedures. Okay, now, analytical procedures are required in the planning phase. We must do that. Okay, now, what an analytical procedure is doing is it's looking at plausible relationships between amounts that are included in the financial statements and other information. And it could be other financial information, it could be non-financial information. And the auditor will develop an expectation, and then they'll compare what they're seeing in the financial reports to that expectation. So what happens? The standards require that we do these analytical procedures in the planning phase so that if something falls outside of our expectations, we know that we have to put additional audit attention on that particular item in the financial statements. Now, they require us to do it during planning. You can see on this slide, they require us to do this during the final review phase. So what happens? Remember, we're auditing the financial statement, but the client's probably making all kinds of adjustments and whatnot. It's not like they just have the financial statements, they don't touch them and they say, here, audit them. While we're auditing them, there's different adjustments and whatnot that are being made. So they require that we do a set of analytics at the end to make sure that, again, nothing unusual jumps out from what our expectations are. Now, they allow us to do an analytical procedure as a substantive procedure, okay? Now, when we're at these required planning and final review, we're at a high level. When we're doing a substantive procedure, we're probably sitting there and using disaggregated data. We're probably looking at revenue by product line, by store location, that sort of thing if we're doing a substantive procedure, okay? Now, if we're doing an analytic as a substantive procedure, okay, they say that analytical procedures are most efficient for those areas where we do not expect there to be potential misstatements. So we're comfortable doing an analytic procedure, which is basically going to sit there and compare our expectations to other data. It's not a test of details where we're actually looking at invoices and that sort of thing. Okay, so they allow us to do that. Or the blue I put here where the detail is unavailable. Sometimes you won't have the detailed evidence to allow you to look at a transaction level or to test of details. And if that detail is not available, then you may revert to an analytical procedure. Okay, but we're required to do them at the planning phase. We're required to do them at the final review phase of the engagement. Okay, high level though when we do these. Okay, so let's just take a look and see how we would do them, analytical procedures. Okay, we can see that we're doing them in the planning phase as risk assessment procedures, substantive analytical procedure. We may do that if we want to. And then the final review stage. Now, let's just get a sense here. And I think what I'm going to do is call up the whiteboard here for a second. And let's just use a little example of analytical procedure. So let's say I'm asking you to audit, we're auditing a laundromat, and I want you to audit the washing machine revenue. And let's say I tell you, I want you to use some operating data of the client to help me with this analytical procedure. What might be an example? Do you think if you were auditing a laundromat, what might be some operating data that you could use to audit washing machine revenue?
Deposit receipts, maybe?
Deposit receipts, okay?
Yeah.
Okay, to see if they actually deposited, okay? But I'm thinking that's financial, right? I'm looking for something non-financial, or maybe that's a better for me to say.
The water usage?
Huh?
The water usage?
Yeah, right? So what happens? I'm sitting here and I pick the water bill. Pick up the water bill. And it turns out they use 10,000 gallons of water. I'm sure a laundromat probably uses more than that in a year or whatever, but let's just keep the number small here. So it's 10,000 gallons of water, okay? And let's say, just for, and I don't know how it works, but let's say that each load uses 2 gallons. Okay, so it's 2 gallons per load. That means that I'm thinking that this client has what? How many loads of laundry? 5,000 loads? Now, if I'm thinking that this client is using 5,000 loads, and I don't know, again, I don't use a laundromat, so if my numbers are crazy, consider the source. Okay, so let's say it's $3 per load. So I take that 5,000 times the 3,000 per load, and the auditor develops an expectation that the washing machine revenue should be about $15,000, right? Okay, now, am I going to kill management if it's not $15,000? No, this was an estimate that I made, right? So what the auditor will do is put a range on that, okay? And often it's a plus or minus 20%, okay? So that means, and guys, when you say, hey, John, where'd you get plus or minus 20%? The standards don't call out what the range is for the expectations, okay? They just tell you to develop a range of expectations, and that 20% depends on the audit firm, depends on the auditor. In my office, the GAO, when we would do analytics, the financial audit manual tells us we have to have a 20%, which is a common one, but it's not written in standard anywhere. But that means it could be as high as what? As high as 18, could be as low, if I'm doing my math correctly, what, 12? Okay, now what happens? Let's say they report washing machine revenue of 17,000. Is the auditor happy or sad? That's a happy auditor, because I thought, okay, I was willing to go as high as, my estimate was 15. I was willing to go as high as 18. They're at 17. They're where I want them to be, right? Let's say that they report 33,000. Now, is this auditor happy or sad, do you think? And, someone just want to say? Okay. This is, the mouth is open, not because he's shocked or anything. This auditor right here for this 33,000's mouth is open because now you start to ask questions. You say, hey, look, we use the water bill and we develop an expectation and we were giving you a little plus or minus. You're outside of the tolerance. Do you have any explanation? And management says, you said you used the city water bill? And we say, well, yeah. No. Yes, we use city water for our normal customers, but we have some very, prestigious customers or high level customers. They don't want their laundry washed with city water. They want their laundry washed with rarefied water from the mountains. And so we're going to go ahead and we have water trucked in for them. Oh, okay, well, we didn't realize that. So now we say, well, can we now turn a little bit more towards the test of details? Let us see the invoices for the trucking water and see if that accounts for the difference. If that accounts for the difference, then we're satisfied with that difference. We got that explained. Okay. Now we did this with this washing machine revenue because it's pretty hard to figure out how many quarters got dropped into a machine over the course of the year and if that's a reliable number. So again, remember we do an analytical procedure where we think, hey, there's maybe not this statement here, or where detail is not available, we went ahead and we used the water bill. But then if we do see differences, then we're going to have to turn to a test of details. In this case, we started looking at the trucking bills. Okay, so that just sort of gives us an example where now, as we start to look at some of these other slides, we can harken back to that example, which is what we develop an expectation. The expectation could come from what? Could come from operating data like a water bill, non-financial, could come from budget forecast, could involve just looking at last year's numbers and seeing that we would be within plus or minus 20% of last year's numbers, whatever. Okay, so we can use different sets of information to develop the expectation. Okay, then we would define a tolerable difference. That's the what? That's that plus or minus 20%. Okay, we're willing to go as high as 18, as low as 12. We fall outside of that tolerance. Then we're going to do what? Then we're going to make the comparison and investigate any differences. And then we'll have to explain those differences by applying additional audit procedures. For example, looking at the trucking water bills, etc. Okay. Okay, so analytical procedures, you have to do them. They're required in the planning phase. They're required in the final review phase, right? Got to do them. Planning phase, if something falls outside of the tolerance, we can't get a good handle on the reasoning, then we know that we're going to have to expend additional audit resources to get behind that difference. Final review phase, make sure everything's still making sense. And then you could do it as a substantive test if you decide you want to. Okay, so this next question that I kind of got a glance at is going to ask us what things are required to do or we're required to do in an audit. We're required to do analytical procedures, right? In the planning phase, final review phase, we are required in all audits to do risk assessment procedures. We're required to do substantive procedures. Sometimes we do what? We do test of controls. And so you take a look and which of the following are ordinarily designed to detect possible material monetary errors. Well, analytical procedure could help us identify a monetary error because we're developing an expectation and comparing what they recorded to that expectation. Okay. Test of controls, post-audit review of audit documents. That's a quality control step. None of these things are going to help us to identify monetary errors. It's going to be the analytical procedure. These other two are what? Controls don't help you find monetary issues. They help you find where there's a problem with the internal controls. And post-audit review of audit documentation is probably post-audit is something that's done in our monitoring, maybe during a peer review. That's not when you're looking to find monetary errors. You're going to be doing that in the conduct of the actual audit. Okay, let's take a look at this one. An auditor decision either to apply analytical procedures as a substantive procedure or to perform a test of transactions and account balances usually is determined by, and we say, the relative effectiveness and efficiency of the test. Okay, so availability of data at an aggregate high level, that's not when we're talking about doing an analytical procedure as a substantive. There we were looking at what? Data at a disaggregated level. We're probably looking at things as minute as gallons of water that got used. Okay, timing of tests performed after the balance sheet date. I'm not even, sometimes guys, I can't even explain to you what some of these wrong answers mean. Audit familiarity with industry trends. We're probably going to do that at a high level when we're doing the plan. What should be the revenue for an entity in this industry? My client is significantly outside of the range for companies in this industry. I'm going to put more audit procedures on that. That's in the planning phase, okay? But the relative effectiveness and efficiency of the test is much more efficient for me to use the water bill for something like washing machine revenue than sitting there trying to determine how many quarters got dropped into a washing machine at any point in time. So again, if you can come up with an effective test for your substantive procedure where the test of details is not going to be possible, then you would move to a substantive analytical procedure.
I have a question. Can you explain a little bit more about what exactly is this? I mean, so the little diagram you did, the exercise you went through with the laundromat is a substantive procedure. Is that an example?
Yeah, that was an example of using really an audit procedure, an analytical procedure, excuse me, as a substantive procedure. But yeah, let me back up a little bit, because it gets a little hard to talk about this before we've seen what we're talking about substantive procedures versus control procedures. So substantive procedures are designed towards dollar amounts. Okay, so let's say, let's just go back to that example. We were trying to support the washing machine revenue, which was a dollar amount, including the financial statement, 17,000. Is that a reasonable number? We applied procedures around making ourselves satisfied as that dollar amount. The confirmation of account receivable that we had, that was designed around dollar amounts, right? Control procedures are more designed to see if the control was applied. So let's say the control procedure is that the supervisor is supposed to sign a time card, right? So we know that the supervisor is saying, yes, this employee worked 40 hours. And so we look for the control procedure, would look for the signature. We're not looking at dollar amount, we're looking for the attribute, the signature on the time card. The substantive procedure would be then taking that 8 hours or that 40 hours, whatever, and seeing that that 40 hours was properly posted into the payroll ledger, and then that it was multiplied correctly by the employee's wage, because that's around dollar amount, that's considered a substantive procedure. So control procedures, substantive procedures. Control procedures are looking for the attribute that evidences that the control is there, signature of the supervisor. Substantive procedure is looking at dollar amounts. Was the dollar amount properly recorded in the financial statements? Does that help?
Yes, thank you.
Okay, now this is a good question because it allows me to now go back to that. I'm not going to go back to the slide, but just picture it in your mind. Remember the slide that said that you always have to do substantive procedures, but sometimes you do control procedures? So let's just go with this time card example. Let's say I look and it turns out that the supervisor is just a derelict. Okay, supervisor, the employee, the work shift starts at 8 and the supervisor gets there at 12. And the employees are all punching in and doing their work and everything, okay? But the supervisor doesn't get there till 12. Is that supervisor's signature an effective control? No, it's not effective because the supervisor's not there to know if the employees are actually doing their work during the course of the day, right? So if I look and I say, well, look, I did some preliminary looks at the internal control and the control was not implemented, it's designed well because the supervisor should know how many hours their employees work, but it wasn't implemented because the supervisor is a derelict, doesn't show up. So that control is not effective. So I don't have to test that control. They don't make me go back to look to see if the supervisor signed the time card, because even if he did, or she did sign the time card, it doesn't mean anything because they're not there when the employees are there. So I would not have to test that ineffective control. But I would have to look to see the hours. Well, okay, there's 40 hours sitting there, 40 hours times 8. I'd still have to do this substantive procedure to make sure that the amount of hours that the employee clocked in for were properly recorded in the financial reports. And so I would have to do some additional, quite a bit of substantive work there to make sure that I'm satisfied that they're putting down the right time and that the hours are correct. So you still ultimately have to get to the right numbers. So you have to do substantive procedure. The controls would have been helpful for me if they were effective, but in that case they weren't, so I don't have to test the internal control. In that particular case, an ineffective control. Okay, does that help, Donna? I think that's who asked the question.
Yes, thank you.
Okay, yeah. Okay, good. Let's take a look at, we didn't finish this one. Which of the following non-financial information would an auditor most likely consider in performing analytical procedures during the planning phase? Now, this question's a little bit hard, okay? And the reason it's hard is you look and you're like, well, these are all non-financial. Come on, we thought, there'd be 3 financial and 1 non-financial, and that's how you'd ask this. So you have to look at the procedure from the standpoint of which could best lend itself to an analytical procedure. In other words, for which one of these could I develop an expectation about something in the financial statements based on this non-financial information? Okay, so it has to be something that's going to allow me to make an objective estimate of what's recorded in the financial statement. So, turnover personnel in the accounting department. Can you come up with an objective measure of how turnover of personnel in the accounting department could result in misstatement of financial statements? No. What are you supposed to say? For every 3 employees they replace in the accounting department, we're going to get X amount of dollars in misstatement? No, this does not lend itself to an analytical procedure. That's not to say that turnover personnel in the accounting department might not concern the auditor, but you can't turn that into an analytic. Let's see, they fired 5 people in the accounting department, so there should be $10 million in the statement. It's got to be something that you can translate into a expectation that then you can compare to what they have in the financial statements. Objectivity of the audit committee. Oh yeah, every time the audit committee gets 1 degree less objective, that results in $10 million of misstatement in the financial statements. No, there's not a strong enough cause and effect, okay? Management's plans to repurchase stock, okay? Well, they can plan all day to repurchase stock. The question is, did they actually repurchase it? Now, if they actually repurchased it, then you could look at the number of repurchases and see if that translates into some amount of treasury stock or something that they're reporting. But their plans to repurchase when? This year? Next year? They planned, but they didn't do it? You can't turn a plan into something that you end up seeing as a dollar amount of financial statement. Square footage of selling space. Okay, now we got something. What happens? They're selling Winnebagos. I don't know if you guys know what a Winnebago is. It's a big old trailer, that people go on vacation in these big old trailer trucks, right? And the square footage of selling space is, the size of your driveway in your house. Well, how can you sell 10,000 Winnebagos in a year out of a selling space that's only the driveway of a house? That's something that you could probably turn into a decent analytic. The gallons of water, the washing machine revenue. Okay, so when you're looking for something to develop an analytic, you're looking for a nice cause and effect relationship between the item in the financial statements, washing machine revenue, and in this case, the non-financial data, which square footage of selling space in this example, washing the water bill. Okay, good. As a result of an analytical procedure conducted during the planning phase, the independent auditor determined that the gross profit percentage was declined from 30% in the preceding year to 20% in the current year. Now, just to make sure we're cool with gross profit percentage, that's what? Well, gross profit is revenue, or sales, I guess would be the correct term. Sales. I'm not trying to insult anyone's intelligence here, but it's cost of goods sold equals gross profit. And then I take that, I take that gross profit and I divide it by it's really net sales. Okay, net sales. And not to get you in accounting 100 here. Okay, so that gives me my gross profit percentage, right? Okay, now if they tell me the result of analytical procedure during the planning phase, the independent auditor determines that the gross profit percentage has declined from 30% in the preceding year to 20% in the current year, as I had said earlier, that might be something that makes you go, well, why? I mean, why did this happen? Bad year? Was there a big increase in the cost of their inventory that happened? You would start to want to investigate more closely why that happened, okay, and consider the possibility of error in the financial statement, and now start to do some additional work around the inventory. Maybe there's been some error in the financial statements. Maybe they were supposed to use one method. They're supposed to use FIFO, and instead they use LIFO. You start to see what could possibly cause this discrepancy. Okay, now express an opinion that is qualified may be eventually due to the inability of the companies to continue as a going concern. This is nonsense. Okay, maybe you'll end up there, but not at this stage. You're not going to just jump to an effect on your opinion based on this. Evaluate management's performance in causing the decline. I mean, no, we're not really there to evaluate management's performance. There are such things as performance audits. We're here to make sure that the financial statement amounts are fairly stated, right? Require footnote disclosure? No. I mean, analysts can sit there and do their own work to see what the decline was. Now, if there was some significant event that happened that caused this decline, then yeah, we would expect them to disclose that. But the best answer here is, hey, there's possibly an error in the financial statements. I did this analytical procedure. Let me design my audit procedures to get to the bottom of what's going on here. Okay, it looks like we're going to continue to chase our tail here into the next class, because I don't want to start materiality, at this stage, because I need you to be fresh and fully alert. So unfortunately, I'm going to stop it there. We'll pick up. I'd like to someday get done with the whole planned chapters for the week that we're in, but I think that that's less important than making sure that you're comfortable with the material. Okay, so outside of the materiality questions from chapter 3, though, you should start to look at the quiz and the homework questions, obviously, for chapter 2. Now we've gone all the way through that. The quiz and homework questions for chapter 3 outside of the materiality. So you'll probably have a little trouble with those right now because we haven't talked about that. So skip those when you go through the homework, and then we'll come back next week, start with chapter 3, and I'll keep pushing towards making sure that we cover all of, hopefully, chapter 3, the rest of chapter 3 for sure, and chapter 4 next time. Before I do that, any questions, concerns, things I can address at this point while we're together?
I have a question. This is Dobby. So should we, do the homework but don't do the materiality questions? And should we do the quiz and not do the materiality questions or?
Yeah. Yeah, don't worry about those right now. The materiality questions, Dobby, because what I'm doing is I'm going ahead and I'm going to award the homework points sort of towards the end of the term here. So don't worry, you don't see those homework points translating into e-learning, et cetera. At this point, I'll award those points towards the end. Homework to me is a means to an end, not an end in itself. So I'm not sitting there with the checkboard saying, hey, did you do all the homework assignment? Check, clipboard. Did you do all the homework assignments by a certain date? So just skip those for now. But yeah, do look at the other areas other than materiality, just so you're starting to get a sense as to how I'm going to test that stuff, because I don't want you to wait till the night before the exam to start to look at that stuff.
Okay, and one more question. So we'll be able to go back in there and pick up the quiz, for example?
Yeah, oh yeah, it's there, frankly, past the end of the class.
Oh, okay, okay.
Yeah, so it's all still there, okay? Okay, good. I'm writing down names because I want to make sure that we're not getting in the habit of leaving at the break, okay? I mean, we've got the class here at 5:30. I don't tend to keep you all the way till 8:10 or 8:20, whatever. It was supposed to be 8:10, okay? But I do kind of expect you to hang in the time of the class. I'm of course preaching to the choir right now. In case folks are watching this, make sure you're carving out the time to stay in the class. I don't want to start talking to myself here. This is a synchronous class, so you want to make sure you're here for it. Okay. Good work, guys. We will see you next week. Okay. There's no other questions?
Thank you.
Okay. All right. Thank you. Have a good night.
Thank you.